All right, you guys, welcome. Doug McKay, antiwallstreetguy.com on Friday night, the 13th of January, 2012. For the Saturday radio show, we have the overall trend in the equity markets is long, meaning it's a buy. We are above the 30, the 50, the 200-day moving average. We are above, again, the downward sloping trend line. We are running into resistance here at 1300. We would be concerned if we were to be capped by 1300 and we were to break through 1260, and then certainly 1250 would be our line in the sand. That's pretty much where the downward sloping trend line meets, as does the underbelly of the channel, and also the 50-day moving average. So 1250 is the number we'd want to be concerned with. And we'll take a look at the the SPY as well, because on that chart you can see the gaps. But anyway, this is a daily chart of the S&P 500. A close above the highs of this week on an intraday basis would be nice, but the overall trend is still intact. It's long. We did take a little bit of money off the table this week in the managed accounts. We let go of our DVY. We wanted to raise some cash. We'll take a look at that chart. This chart is still holding up. We were looking for areas to raise cash. So we took some money off the DVY. We also took some money off, if not liquidated entirely, in many of the accounts, the XLP, which is consumer staples. Once we start to see this rolling top, the odds are increased that we will go back down and test the most previous breakout area. So what we don't want to do is ride that back down to 3150, because from a percentage standpoint, that's a decent amount. This is also what occurred with the XLU, and this is why we exited the XLU last week, because once we broke out, this was our buy signal here, especially with an increase in volume. But at the same time, this day it started to fall apart, which increased the odds that we were going to go back and test the breakout area of right around 35. It did that, and then today we closed below the 50-day moving average of 34.89. So in simple terms, we are out of the DVY, the XLP, the XLU. We do have a position in the SPY. Now let's take a look at this on a daily basis. One of the things we were concerned about are these two gaps. This is a chart that went out to our 4-minute traders. Both of these gaps as of the close yesterday were not filled, but as of the close today, they are filled. You can see that we came down intraday on the SPY and filled that gap. We have yet to fill this gap. But again, very similar, maybe even more of a clear picture than the S&P chart is this chart that we have up of the SPY, where we kind of want to hold this support area of 125, which is the 50-day moving average. It's also part of the downward sloping trend line and the underbelly of this channel. So 125 on the SPY equates to 1250 on the S&P. When we want to take a look at some of the other positions that we have in terms of whether or not they are holding up technically, as an example, Qualcomm. This is a position we have in several of the larger managed accounts. Even though a negative down day in equities, Qualcomm was up today. More importantly, it's holding this 55.50 level and also the 50-day moving average. So we kind of got above this area here, which was our area of resistance. And once we got above that area of resistance, that was our sign to get on board Qualcomm before it extends itself too far beyond its buy point. The other one we were looking at that we have is Cisco. We did not wait for the close above 19. We got in a little bit prior to 19. Again, we want to see this hold 18. Probably get concerned if we broke through 1850, 1849 on Cisco. As far as Apple goes, some individuals that had a bigger position in Apple, we took half off of this during the middle of the week. And again, great stock fundamentally, technically, but we believe that there's a lot of open air, open space, white space, we call it down here, where this could possibly eventually fade back down to a 50-day moving average, which at this time is right around 393, 394. It could also come back and fill this gap. So we're going to keep an eye on this when the markets open on Tuesday. We're really going to keep an eye on these lows that were put in on Wednesday and Thursday to make sure those hold on a closing basis. If for some reason this came down and we were out and it stopped falling and then it built a base and then eventually got to new highs, let's say above 424, 425, we would either get back in or increase our position if we were not out at that time. But for right now, what we don't want to do is take this thing, down to 394 if in fact that's where it's headed. When we look at treasuries, as we mentioned in the some of the still charts that went out last night, this is a chart of the 10-year. On a daily chart, we closed today at basically 185. But it's quite possible we could be heading to test the lows that were put in, back here in September. And that low was, as you can see in the box there, 1.7%, we'll call it. So that bodes very well for the ETFs that are tied to treasuries. Like the TLT, we did put in a gap today, closed off the highs. This gap could get filled next week. You can see that the downside gap was eventually filled, right? This also bodes well, obviously, for IEF. Now, on both the TLT and the IEF, we still have double and triple tops. So if you're going to get into these, again, I would probably use the 50-day moving average along with this lower trend line as your area of escape to get out in the event that there is no breakout here. Or what you could do is just wait till we got above 106.20, or when it comes to the TLT, you could wait till we got above basically 122, maybe 122.50. But my point in this is seldom do we see this non-decoupling. In other words, equities and bonds working together. One is going to give way. And my bet would probably be that equities are going to pull in here a little bit and treasuries will continue to rally. But we'll see. We'll let the charts dictate our moves. Again, as far as gold goes, no real clear direction here. Still below the 50-day moving average. This was a target to the upside if you were playing a bounce here. But with the managed accounts, we have no position in gold at this time. In my own personal account, I've been short gold, meaning long the DZZ for quite some time. But until I see us get above basically 1,700 on the gold contract, I'm going to stick with that short position in my personal account. As far as dealing with it in the managed accounts, it's just too volatile at this time. Speaking of volatility, let's check out the VIX here. This is one of the reasons that we took some money off the table in the managed accounts on Tuesday. We thought that the VIX was kind of low. You can see we popped up about 2.15% today. I know some of you like to trade based on your emails. The VE or the VXX that was 2.71% today to the top side. As far as the Indu goes, looking for 12,250 to hold. Again, we think if we kind of break this little area here, the odds are we'll probably come back down and test 12,000. But very similar to the S&P, where we have 1,300 as a cap. At this time, we have that cap of 12,500. But other than that, we always want to point out the concerns and the what-ifs and where to get in and where to get out. The overall trend for the equity markets, again, for the fourth Saturday in a row, is long. We'll stick with that. We'll keep an eye on 1260 on the S&P. We would definitely be out if we broke 1250. All right, you guys. We'll see you next week on the blog. Thanks.